Hi everyone, welcome back to BeRich. It's me, Vinod, recording remotely from London yet again. Today I wanted to talk about what's been happening this year so far and how we should be thinking about, as we're closing out this year, what we should do going forward, looking at the trends which we've been seeing this year, where we are right now, and hopefully give you some clarity on where we should be heading next year. So, as an investor, we should always be prudent in what we decide to do and make decisions based on numbers and facts and also on macroeconomic fundamentals. We should not get carried away, as we've been saying many times, with headlines and market sentiments and focus more on long-term growth. And the case in point is, of course, what Berkshire Hathaway has been doing and what Warren Buffett's doing. Gives a lot of clarity on the way he's piling on cash and getting rid of stocks. Give you a fair indication on how a true value investor approaches these situations. In the beginning of the year, in April, on Liberation Day, when tariffs were announced by Trump, there was initial panic in the market and the famous Trump dump happened, where anything but US abuser, as they call it, was the theme of the day. And this led to a lot of people withdrawing from American markets because of lack of clarity and the fear of, each person running to their corner of the ring and sitting there and trying to figure out what happens. Then this led to a partial reversal because we saw Taco Trump coming out, where he would say one thing and next day withdraw from that and do something else altogether. Case in point, what's been happening with trade negotiations with China, Japan, Korea, even this augmented reality we live in with him and as Indians, where just a year ago we were considered to be strong partners. Now I think we are ones with the highest tariffs. And all the time he keeps claiming that him and our Prime Minister have a very close relationship and they're friends. But this is business, as he says. There's a lot of confusion there too. So this Taco Trump has led to, a lot of reversal in a lot of positions people are taking globally when it comes to American equities. International equities, if you see, has beaten the S&P 500. If you take the ACWI ex-US, it is up 26% this year, while the S&P 500 is only 15%. This is very rare indeed, because usually the Americans are the ones who are leading these, growth. If you see in history, and if you look back at stock prices, the American S&P 500 always performs well or even better than the rest of the world. The main reason why the S&P 500 is so lopsided is there's a concentration of risk in the S&P 500. What's happened is it's become very extreme, with the Magnificent Seven making up more than a third of the S&P 500 market cap. On 37% is what I was looking at last. And this trend is led to a lot of, fear in the market. And we've seen that recently with the selling of AI going on. And I will talk tomorrow more in detail about how companies like Meta are, using debt and debt funds and reminiscent of what happened in the past. But this trend seems to be changing as the year has progressed. There's been more inflow into US. So the question remains on what to do as small investors as we are, what we should do looking at this market situation. Should you be avoiding the S&P 500 or should you be going all in looking at what is happening in the US, because the US is the world's largest economy? So I would say choosing the index to invest matters. The NSCI World Index ex-US, which has mainly, you should focus on developed economies in that. That is an index you should be looking at. Then the ACWI ex-US, that is developed economies plus emerging markets, is something you should also be looking at in terms of index. But do remember, concentration doesn't mean bubble all the time. because earnings can sometimes drive real growth. It's happened in the past. So I know we have not seen this kind of earnings for some time, but it has happened, especially we take history, dial history back way back to World War II, post World War II, when there was a boom. We saw this kind of growth where earnings growth accelerated as economies found peacetime and there's a lot of influx of cash into the market. But that situation is different. This situation is also different. The world is not right now going through some peacetime where everything is peaceful and people are opening up their economies and countries are opening up to each other for the first time. That kind of dam breaking is not happening. So you'll have to wait and watch. I'm sure a lot of you understand when I say wait and watch. And you should study each company individually on their earnings and see if the earnings make sense with what they're claiming. So don't build strategies on what Trump is doing, because we've seen the case in point. The government shut down in the US. The Congress is not working. He's not able to do anything there. There's a gridlock. And now they're talking about, cutback in freight in air in the US. Imagine during holiday season when they have Christmas and Thanksgiving, which is so big for them. Shopping is massive for them at this time of the year. There is going to be cut down in air freight thanks to the government shutdown, and even the Supreme Court questioning, what he's doing. His own conservative judges who he's appointed asking questions about what he's doing as far as Congress and getting approvals. So they move against him and say, no, you should get congressional approval for all this, and the government is shut down. We can imagine more confusion is going to be there. So don't build your investment strategies on what Trump is saying or what Trump is doing. And another thing which Anand keeps reiterating is don't forget the strength of the dollar. The world still uses the dollar as a reserve, and the size of the American economy. We're not talking about, yes, there is a concentration of risk, but there's another side to the American economy under the hood. So I would suggest that you deep dive into sectors which are being ignored by the market and look at American companies which are being ignored and not being loved. And these are some solid companies out there, some of them with very little debt and with a proven track record, years of proven track record. So that is something worth looking at. That said, fund flows doesn't mean it's equals to fundamentals. Remember, investors always don't behave on fundamentals as we should. Investors behave on sentiment, they behave on fear and greed. So you should always not equate a flow of funds into a sector or a company as meaning the fundamentals are very good. I would suggest you should look at it as interesting and deep dive into it and see what is the reason for that behavior. That will give you a lot more idea on why, what is happening in the market. Then I would like to hit upon this thing known as valuation dispersion. So there are opportunities even here in Europe, in Japan and other emerging markets. True. But often cheaper doesn't mean, it is the best thing to do. Don't go for looks cheap just based on headlines. Check the sectors. I would say in these markets, industrials, energy and banking could be something you should be looking into. Like I said, cheaper doesn't mean it's better. So going forward for the rest of this year and the next year, I would say the theme should be a balanced exposure and maintaining flexibility as an investor, because we are going to have some more volatile times ahead of us before we get to something stable. Like gold itself has now stabilized around at $4,000, and that seems to be the new level it's going to be sitting at. And if anything, gold starts moving, it's going to only move forward than move negative is what Anand feels. And I also agree with what he's saying, based on where everything is standing and the Fed is standing. And, the new chairs Trump is appointing into the Fed seem to be more leaning towards this idea of lowering interest rates. So that is going to be something interesting. I had put up a post on LinkedIn about the rise in delinquencies in the US, in especially commercial real estate. And that is something I suggest you go read if you have some time to give you a deeper understanding on what is happening with interest rates in the US in terms of regional businesses and regional banks and how credit is being squeezed. And if these higher interest rates continues, like what Charlie Munger said, we're going to have some real interesting times, especially coming forward into next year when a lot of these get into refinancing, these commercial properties which have been taken on debt. So be careful when you're investing. Don't get carried away. Be prudent and understand the fundamentals of what you're doing before you deep dive into it. That is why yesterday's video, I was talking about the cement sector and I was talking about construction. Now, there is a Japanese company also which I want to hit upon, which I'll try and cover tomorrow or the day after. And there's another American company also which I want to talk about, which I'll try and cover the day after too. Anyway, this is something to give you some food for thought over the weekend as we prepare for the next week and look for more opportunities to invest in as value investors. Thanks for being with me on BeRich today. And I'll try and bring Anand in soon when he has time available.